Well, thanks very much for the opportunity to present again today, and I hope everybody's well. It's certainly been an extraordinary year, but when I sit here today and look forward into calendar year 2021, I'm really optimistic around what the fortunes look like to me with respect to risk assets. It's been interesting coming into the back end of this year. There's been a couple of quite important milestones that I've been looking forward to. The first is the vaccine. So we've talked a lot about the vaccine during the course of this year, and our optimism was building as we moved in towards the back end of it with respect to getting some evidence of efficacy and vaccines that could be rolled out around the world. And we've had that now. So we've got that both with Moderna and Pfizer. Also AstraZeneca looks like another credible alternative as well. So the reality is, as we move into next year, that we will see, I think on account of that, some genuine shift towards a more normal environment for the world, which would be really exciting. The other thing is that we are going to continue to see policy very supportive towards risk assets. So one of the frustrations in the last couple of months has been around fiscal policy, especially in the US. So going into the election, both the Democrats and Republicans really struggled to get some form of partisan support for the next fiscal policy, but an initiative. But as we sit here today, even overnight, there was some evidence of progress being made there. It won't be as large as what could have happened under a full Democratic or Democrat sweep of the elections, but still it will be well received, I think, economically and by investors. Valuations are something which comes up a lot in discussions with clients. So after having such a strong bull market, people assume that markets look very expensive. And one of the challenges that we have as investors at the moment is trying to reconcile between sort of absolute valuations, which do look expensive, and relative valuations, which look more productive. So when you look at absolute valuations, I'm talking there about valuation measures such as price to earnings ratios or price to book ratios. They typically capture an assessment of what people assume a market or a corporation will deliver in terms of outcomes over the next 12 months, principally in terms of their earnings. And when you look at those in an absolute sense, markets do look expensive, and we're up around the 90th percentile. But one of the lessons that I've learned in the last decade of investing money especially has been the absolute importance of never forgetting the relativities between the absolute valuations but relative to interest rates. And at the moment, when we look at those numbers, it still looks as if you have a high level of support in a valuation context at that level as well. The other big thing I think about next year is going to be this issue around style rotation, which is going on in markets. And I think this is probably the most important aspect for investors to get their mind around as we move into calendar year 21. So what we've seen over the last 13 years really has been, and this comes on the back of the GFC, was we had a situation where interest rates were cut to a level which really supported a shift back in favour of growth stocks over value stocks. That is beginning to unwind. Now, if we look back through a much longer history of capital markets, you'll see that value as an investment style typically outperforms. What we've seen because of that interest rate setting is that has been reversed in the past 13 years. But what we saw in November, and it's a really important thing to observe, was a massive rotation back in respect of value over growth. And that happened really because of an improving level of confidence from investors around what the growth profile looks like next year and what we're likely to see in terms of the shape of the yield curve. So even though we don't expect interest rates to gap higher, what we do expect to see is that the longer dated bonds will begin to move higher with respect to the yields that they are offering. And that is quite a supportive environment for value stocks. So areas that we're seeing really strong improvement coming through at the moment are in places like the financials and the banks, not just in Australasia, but also in globally. The resource stocks are doing very well. And some of those companies and industries which are more directly tied to the underlying economic cycle certainly are receiving a lot more investor interest and support from where they have been in the past couple of years. So I think that's going to be really important as people understand that importance of rotating their focus and direction away from growth back in towards some of the more traditional cyclical and value stocks. So that's really everything. It's been an incredible year, and it's been amazing to be an investor within the environment which has been so unpredictable and uncertain. But as I said, as I look forward into next year, I'm very confident around the direction of risk assets and in particular equities.